at M2 levels on the right-hand side, it's coming down from historically high levels that shot up during the pandemic and the economic lockdown. You can suck a lot of money out of this economy before you start tightening the real economic. Good afternoon. It's Jeffrey Christian of CPM Group. It's about 3:15 in the afternoon on Tuesday, the 30th of May, 2023. I'm going to talk today about the overall economy and the gold market in some detail. This will probably be longer than usual. Sorry about that, but I think that there are a lot of people who want these details and accurate information, so we'll give it to you. I also want to talk a little bit about some charlatans. First off, 37 years ago today, Goldman Sachs struck my offer to let me spin the Commodities Research Group out of J. Ayer and Goldman Sachs and create CPM Group. I wanted to run an independent, unbiased commodity research and consulting company that was paid to provide research, analysis, and advisory services. They had no conflicts of interest between its analyses and its place in the market, but also had this massive amount of knowledge and experience on how commodities trade that has never really been replicated by desk analysts without in-the-market experience. And having come out of J. Ayer and Goldman Sachs, we were involved in a lot of things, including some of the first gold loans from central banks, one of the first two and many other gold loans for project financing to mining companies, options developments, and a variety of other factors. 37 years ago today, I had actually proposed doing this in late 1984. Goldman said no. I reproposed it in January of 86. Goldman said no. And by March of 86, I think it was pretty clear to them that I was going to do it. So we reached a deal, and they came in and said, okay, give us that proposal on May 30th of that year. Before I go into the economy and gold, last Friday, a friendly Canadian institutional equity sales manager, after he saw our Friday video, sent me a link of a fellow who pontificates about markets online, and with a newsletter and other things. And the video was about how he was positioning himself for the next stage of the big gold market. You know, gold is perfect conditions to go to record highs. And I wrote back, I said, thanks. Fred's been singing that song for more than a decade. And just within 5 minutes online, I was able to find a thing from 2013 in which he was saying that gold was about to skyrocket. Just as it was on, that was February of 2013. In April of 2013, it broke below 1580 and went quickly down to about 1280. People blame Goldman Sachs for it, but Goldman actually was wrong-footing itself in the market at that time. And it was actually more than 1,000 institutional and individual investors who said, let's sell gold on the day that the price fell as sharply as it did in April. But here's a thing from 2013, right on the precipice of a sharp decline and a 5-year bear market for gold. Hey, gold's going to a record. Here he is again in December of 2020. Gold's going up. Here he is with a similar prediction in 2022, but the article was taken down. Well, February 2022, Russia invades Ukraine. Yeah, that didn't work too well, at least until now. We could go on, but the point is, why would you listen to anybody who's been so consistently wrong with his prognostications? You should get good research from a company that has been right more often than not, and right more often than all of the true believers and pontificators on the internet. Now, to be fair, it's nothing new. That fellow's been talking about this for years. So then, when I got this on Friday, I said, I spent a couple minutes. First off, our video came up, And the advertisement that YouTube had put in front of our video was someone assuring investors that something big was about to happen before the end of June that would change everything and destroy people's wealth. So they better take this person's advice and presumably buy gold and silver because the world was going to change. I spent 5 minutes online and I saw 2 regular YouTube silver promoters who on the 24th and the 26th of May were saying that gold would reach $30,000 an ounce in a few days, or in just weeks, or in a few weeks. I found another one who did not predict how high gold prices would go, but went on forever about how Jerome Powell, Ben Bernanke, and everybody else in finance and in government financial oversight and the banking regulatory industry didn't know anything about economics, but he did. A note to that person, you know who you are. The government did not tarnish your reputation. You did. And another one that assured investors that the global gold banking system was about to fail, he's just been early by the tune of about 20 years, and so on and so on. But again, this is nothing new. These folks have been saying this stuff for years and decades. Now, do yourself a favor. Don't try to figure out who these people are. Don't waste your time trying to figure out who these people are. Spend your time signing up for real research that's unbiased and reality-based from CPM Group. Talk about that at the end. Let's talk about the economy. I've heard that inflation is very high, that we're heading toward hyperinflation, and that the high inflation that we saw from March of 2021 into July 2022, sorry about the typo, was not transitory. These are the month-to-month changes in the U.S. CPI, and it goes back a ways. And you can see that really over the last several months, the month-to-month changes in U.S. CPI are back in the range that's held for most of the time from 1990 into February 2021. If that ain't transitory, I've been told that that employment is plunging in America, but the unemployment rate is the lowest that it's been since like the 1960s. And on the left-hand side, you have non-farm payrolls, which are the highest they've been since the 1970s. And on the other side, you have total employment in the United States, which is at a record number of people. Now, okay, more people live in the United States now than they used to. But employment's not plunging. Inflation's not skyrocketing. But I've been told, don't worry, the world's going to fall into a big recession because of the withdrawal of monetary accommodation. And you can look at M2 and the percent change year over year on the left-hand side here. And you can see it's never been negative before, but now it is. We've got to go to a recession. Look at M2 levels on the right-hand side. It's coming down from historically high levels that shot up during the pandemic and the economic lockdown. You can suck a lot of money out of this economy before you start tightening the real economic thing. And if somebody is tight for money, they really poorly spent it from 2020 to 2022. Dollar's not collapsing. We've beaten that horse. But it still keeps getting up and saying, no, it is. CPM Group has expected relatively lower growth in the United States and Europe and Japan this year, going into a recession in 2024, 2025, a pretty bad recession by these standards, and then coming out, because that's what the economy does. We have a recession, and then we have a recovery, and then we have an expansion. And then when the expansion gets old and big, we have another recession. We're expecting it. We have been expecting it for 2024, 2025 for some time, and we still are. And one of the things that's going on in the gold and silver markets right now is lower investment demand, because a lot of other people who were convinced that we were going to have a recession in 2022, or maybe it was 2023, are now saying, well, maybe it's going to be 2024. Maybe it is going to be 2024. And this is the long-term run of U.S. GDP, recessions, depressions, periods of high inflation, periods of strong growth, periods of smaller inflation. And you can just see graphically the extent to which after World War II, the recessions, the currents of recessions, smaller, less volatile, shorter. And then after 1980, starting with Paul Volcker's central bank work, less frequent and much more shallow until 2008. And even 2008 and 2020 hardly compare to the 1947 recession and the Great Depression and some of the recessions that we saw in the 1890s and 1900s and 1910s. So recessions, they come and go. Less so nowadays, but they'll be back. Let's talk about gold. Gold prices are very high, despite what some people think. Not $30,000, but I've been told just wait a few days, it'll be there. Gold investment demand remains elevated. It was very high in 2020 for obvious reasons, the pandemic, the economic lockdown, the recession globally. People poured money into gold. They came back, pulled back in 2021, but not to low sub 20 million ounces of net physical demand in a year, levels that you had seen in 2018 and 2019. We got about 26 million ounces of net physical demand for gold from investors in 2021, a little bit more in 2022. CPM Group is projecting a little bit more in 2023. Enough to keep the price high, enough to move the price higher at times of uncertainty, but not enough to drive the prices sharply higher as it rose in 2020. At least not this year. 2024, 2025, that's another story, and that's a story that we tell in the various reports that we sell. Long-term statistical correlation between U.S. Inflation and gold, 9%. Long period of time from 1983 until 2021, when gold prices went from $270 to $2,000 an ounce, and inflation actually went from about 4% down to 1%. Inflation does not solely drive gold prices higher. Real interest rates do matter, but the relationship's not as fixed as people think, because what really matters is what's causing real interest rates to be negative or positive or high or low or rising or falling. And this plot diagram shows you the distribution of changes in real gold prices and changes in real interest rates. And over time, the historical correlation is negative 16%. You can see big numbers of times when both real interest rates and real gold prices were rising. And you can see times when one was rising and the other one was falling. So relationship's not as clear-cut. Higher real interest rates do not necessarily mean lower gold prices. We look at a set of factors: inflation, safe haven, currency hedging, strategic investments, alternative assets, portfolio diversification, gold as a commodity. And right now, 5 of those 6 categories are flashing green, i.e. buy gold or add to your gold holdings. And 1 is yellow, and that's the gold as a commodity. Gold ETF holdings, they came down 2021, 2022. They are up a little bit in 2023, but they're still very high. It's not like people have been dumping their gold, because they don't. Gold coin demand rose very high in 2020, stayed high in 2021 and 2022, and it's relatively high still now. On the supply side, we think that in 2023, total supply will get past 2019, pre-pandemic levels. They won't be as high as they were in, say, 2016, 2017, 2015, but they are high. Mine production is rising only slightly, but secondary recovery from old scrap, old jewelry, old electronics is rising more forcefully this year. And all-in sustaining costs are now at record levels, but the costs follow the price. When the gold price started falling after 2012, producers cut back on their costs. The first place where you cut back are the sustaining costs, because those are the things that you can manage more. Cash costs are much more sticky. Labor, the cost of operating your mine. So cash costs were relatively flat throughout this period. Sustaining costs declined, which is why you're seeing less mine production come on stream over the last decade. And now it's starting to rise because the gold price is higher, and it's allowing producers to explore more, drill more, develop mines, develop expansions, and also spend more on the home office. As a result of the rising sustaining costs and rising cash costs because of overall inflation, you're seeing all-in sustaining costs at record levels, higher than they were in 2011, 2012, but still giving the average producer, these are average prices, average costs, still giving the average producer a pretty healthy margin. As Peter Monk, the man who created Barrick Gold, said in the early 1980s, when the gold price went from $200 to $800 and came back and stayed at $300, $315, $316, $350 an ounce, Peter Monk said, "Where do I find margins like that? I've got to get me a gold mine." And so he created Barrick Gold Mines. Similar situation today. Fabrication demand been relatively flat, really, for about 20 years now. Comes down during recessions, comes down during the pandemic and the lockdown, springs back up, but it doesn't necessarily make new highs. It sort of responds to prices and to price changes and the price volatility. And the higher prices and the higher price volatility have kind of restrained jewelry demand. But in addition to that, you have fashion issues, you have income elasticity issues. People feel a little bit less wealthy. They feel a little bit less willing to splurge on jewelry than they used to. Central bank demand covered a lot of this stuff. Central banks bought about 10 million ounces last year. They're buying right now, I think they're actually running about 15 million ounce annual level in the first quarter of this year. We expect 10 to 12 million ounces of central bank buying. Central banks are buying gold, and a number of central banks are buying gold. The gold still represents less than 15% of total monetary reserves held by central banks, although you can see the yellow part of the bar chart on the left. The value of the central bank gold is higher than it was in the past. And the gray part is foreign exchange, which has just risen enormously, especially since 2001. And central banks are not dumping the dollar. Central banks, the portion of central bank foreign exchange reserves that are in U.S. dollars has been relatively stable. There's no concerted effort to replace them. The Brazilians and South Africans and Indians and Chinese do not want to link their currencies to the ruble. The dollar's here for a while yet. Russia started reporting its monetary reserves. The gray line at the bottom is gold. You can see here it looks relatively flat. Foreign exchange has been declining really since the war began, and a lot of that's frozen. And then these are the gold month-to-month changes, month-to-month levels over the last year, just to show you greater volatility. That the Russian central bank, there are times when it's selling gold to raise foreign exchange reserves to meet its import requirements, and there are times when it's been adding gold to its reserves. So it's a much murkier area than the guys who think in black and white would like you to believe. CPM Group will have its second quarter open forum question and answer period for its clients. We're going to have it on the 21st of June, summer solstice. When I was in Jesuit school, Father Conroy used to call me pagan, so I thought, that's a good pagan ritual. 11 a.m. Eastern Standard Time, 21st of June. It's free for CPM Group clients. If you're not a client and you want to participate, go to CPM Group's website, cpmgroup.com, and sign up as a retail investor client on the retail investment program, and then you'll have access to the Q&A period. Usually lasts between an hour and 2 hours. And it's an open forum. You can ask us whatever you want, and we'll answer the questions that we want to answer. You can also go to our website, read about other stuff, buy our yearbooks. These are the 2021s. But we do have our 2022 gold yearbook out, as well as our 2022 silver yearbook. We're now working on the platinum group metals yearbook as well. That's all I have for now. I'm going on about 20 minutes. I'm sorry about that, but I really wanted to spend some time looking at the details of the economy, because they're not as dire as people would have you believe. Some people. They're not as good as other people would have you believe. And I also wanted to go in some details on gold. I did exclude the pictures of the American Nazi Party, which is also known as the Make America Great Again Party, marching down Fifth Avenue and having a rally in, I think it was 1939 at Madison Square Gardens. I was going to throw that in, but for time constraints, I left it out. Maybe some other time. In the meantime, take care of yourselves, take care of those around you, be good to everyone, and try to help the world, because it needs your help. Take care.